So here we're going to kick off, because when we think about what is going to happen next, we have to understand, where are we in importing, exporting, where is the supply chain going to rectify itself? And the problem is, and you've heard me say this countless times, for the last 40 years, we've exported inflation, we've exported our supply chain. We accelerated that again over the last decade. So now we're beholden to what is happening abroad. Before, don't get me wrong, you're always beholden to a global market as trade moves across borders. But as you rely on the abroad for raw materials, for semi-finished goods and finished products, that's when there's no way to mitigate against pricing. There's no incremental where I'll pull a little extra from here. As we talked about in segment 1, there's been a very slow moving nearshoring or onshoring, and that plays out again in the account balance, where the survey was expected to be at $205 billion. Instead, it came in at $214.8 billion in terms of the current account deficit. So we're still seeing a huge amount of imports that's not going away, especially as we start to rebuild and refill our inventories to try to create some semblance of balance. Which is why when we start looking at PMI and ISM service index, the disconnect between ISM and market services PMI measures has really blown out. And the reason why is, it's distorted by supply shortages. And that's when, as you look at supply shortage adjustments, that's when we'll start to see some of this reverting to the mean, if you will. And that will help, because some of the things that are putting in or causing these massive PMI prints aren't actually positive contributors. When you think about the supply chain disruptions, it's adding a positive number, but it's having a detrimental impact to price, to inventories, to just the general movement and function of the economy. So that's why when you start to back some of this out, you get some of this normalization. And that's going to get us to, I think, again, that's why I think when you see this rolling over, this calming down of expectations, that's when you'll start to see, again, this more moderate view on growth. And I think that growth will see a lot of that slowdown, especially with new orders slowing, with backlogs starting to drop back down. And you'll see the most pain on that in the emerging markets, because they've already struggled to sell. They've already struggled to make money at this point. And this general slowdown in trade is going to exacerbate those issues. Now, when you think about some of the biggest issues that we have in the U.S., it's on the chip shortage. So the U.S. is vulnerable. Only 10% of chips are manufactured in the U.S. So the U.S. has lost considerable share of global semiconductor manufacturing over the last 3 decades. Today, a little over 10% of chips are made in the U.S. compared to 37% in the 1990s. Now, there's both sides to this, because obviously it's a percentage, so you're dividing against something. But the demand has gone up and supply has not gone down in the U.S. while demand has gone up. So you're seeing this. We just, again, have exposure for the most crucial ingredients to our daily life. We're at a point where sneakers, light bulbs, everything has a chip in it. You could probably look around the room right now and you're going to see at least 10 things that require some sort of microchip. And I guarantee you 20 years ago, it was 2. These are the underlying problems as we go forward that leaves us open and exposed. So then when we take that and we look at supply bottlenecks easing, well, what does that mean in terms of easing? So let's take the backlog of orders rolling over, customer inventory, again, going to start to see that balance, but the backlog of orders is a negative for future growth. You can see we're at a very high level. So even though it's going to be negative in terms of coming back down to normal, it's still going to be in a growth profile. And consumers and customers in general still have to restock some of their inventory. But the supply disruptions have flatlined. They're off the highs. They're still, again, zooming out, still well above normal. We don't see the supply disruptions getting much better in the near term. They're still going to persist. And even as they continue to improve, it's going to take almost a year, if not at least 6 months, to get closer to where we were pre-COVID. And that will bring down some of that inflation. But at the same time, as the supply disruption index costs come down, a lot of that will feed back into wages in order to close the gap that we've seen in terms of the slack in the economy, which is being driven by that low participation rate. And this is when we look at the U.S. capacity utilization pre-COVID, post-COVID, and that's where there's still that slack. It's getting there, but U.S. industrial production still kind of flatlining, and we need to see this really start to close that gap to see this sustainable growth that we really need. And this is looking at what it was pre-COVID and where we are today. So the capacity utilization rate, there's still about 4% to make up, and that employment to population ratio still has over almost 4%, about 3.5%. And that's where we see, but it's going to take higher wages. And that higher wages is what's going to be needed, which is going to underpin really where a lot of this is going to go on that inflationary standpoint. And but on the same time, the consumer confidence index rose. The expectation was for 111, came in 115.8. And when you look at expectations improved to 96.9 versus 90.2, present situation ticked down slightly from the prior of 144.4 to 144.1. So the conference board is looking, look, things are stabilizing. We're getting, and that's where I think you need to see this point where let's pause on some of the monetary, fiscal, abrupt money printing, and let things really move through the system. Because even though they look favorably on some things, Americans' economic confidence per Gallup has soured considerably on the economy, falling to the worst since depths of the pandemic in 2020, but yet still obviously off of the lows from the great financial crisis. But you're looking at people are more and more concerned about the economy. And as they get more concerned about the economy and their wages and that'll impact how they spend, what price they're willing to spend at. And again, those are the things that will become that overarching kind of cap to where prices really can go, leaving again into that stagflation. So then the leading indicators is up 9.4% so far this year, which is the fastest annual gain since 1983. And there's a lot of reasons behind it. What is driving some of these increases? And that's when you start looking at the jobless claims. So as jobless claims continue to fall, that is the biggest bump. And just think about where we had in terms of the jobless claims. We went to such a massive level that we can continue to see that come back in 2021, which again drives up a lot of these leading indicators as everything else is fairly normal. So then when you look at the despite minor downticks, inventory components of both Philly and Empire manufacturing indices remain in expansionary territory, underscoring continued healing in supply chains. So as those supply chains, this is just bringing down underlying cost, but as PPI reaches a record in Europe again, reaches records in Asia, we're beholden to those import prices. And so that's where, even though some of these benefits might happen in terms of just cost on shipping, the stuff that's on the boat is still going to remain expensive. And that's where we get some of this competing pieces where the stuff on the boat is still expensive. The cost to move the boat has come down, and some of that will then get passed on into wages, leading into those friction points. And then understanding the personal income dynamics, as we've been talking about, compensation is a huge piece of it. As transfers to households have gone down, unemployment benefits have expired, and that's where we're getting this flatlining, and that's where we're getting the pressure on the compensation, and that's why it's so important to see wages go up, because otherwise we're going to continue to underscore the problems against rising costs. So the share of consumers who opted out of purchasing an item last month for the different reasons. So when you look in November, decided not to purchase an item because it was more expensive, because of the supply chain shipping issues, or canceled an order because it took too long to arrive. You can see just some of those things are getting a bit better. And that, we already saw what happened in November. That should improve further in December and help some of those underlying prices get a bit better. So then when you look at household debt services, they remain very low on a global basis. And that's just because obviously, we're at very low rates, which means that when people have been able to roll their debt, they've been able to do so at more favorable terms, but then they've also accumulated more debt on top of it, which that's fine until it isn't, as we've seen in 07, 08. And this is going to be, I think, some of those risky points, because even though the debt financing is low, there's a lot of assets behind it. And as those assets lose value, all of a sudden it becomes a bit more expensive and a bit more risk. Now, one of the other sides of the reason why we should see an additional slowdown in activity from the Fed is when you look at the unemployment rate and the non-cyclical rate of unemployment, or what is deemed as full employment, because you're always going to have people quitting. You're always going to have different layoffs. So you're always going to have some unemployment. So you can see that we're now below the level that is deemed of natural unemployment, which just speaks to more slowing of policy and adjusting for where rates currently are. Then when we take that and we look at the U.S. industrial production manufacturing, more evidence of thawing in the auto world, with motor vehicle and parts and industrial production picking up in November. And we see some of that, again, accelerating as some of these supply chains get a bit better. But while this is happening, when you look at inflationary pressures, the Manheim U.S. used vehicle index is up 48.9% year over year as of December, just beneath the all-time high of 54.2%. But you can see that reacceleration, and a lot of these used car prices are remaining elevated due to, even though you're getting some normalcy on the assembly line, you still have a shortage on the lot, which again is leading to these prices remaining elevated. Now looking to real estate, November existing home sales were up 1.9% versus the 3% estimate. First-time buyers, just 26% of November transactions, down from 32% a year ago, and matching the lowest share since 2014. Median selling price at 13.9% year over year to $353,900. And this is where we keep talking about who is the next incremental buyer. And we keep talking about how we're losing the next incremental buyer because that volume of individuals is going away because they've already satiated their appetite. They've already bought an asset. So as that continues to dwindle down and those new buyers go away, that's when we're going to see some of this cap on the real estate side, and then some of the declines that we've been discussing on price. Housing completions ticked up in November, but are still lagging starts by a wide margin. Completions in a lot of these are due to delays from labor, supply chain shortages in terms of raw materials. So housing unit starts continue, but then the ability to complete them keeps getting pulled out and pushed out due to the delays at the construction site. And then under construction units, you can see single family, multifamily, both exploding. Again, same thing. They're trying to do it, but they are missing the opportunity to continue to do it, just given the issues along the supply chain. And then single family, multifamily slowed down a bit. Multifamily stayed elevated. Single family has slowed down a bit when you look at housing starts. And a lot of, as we've been talking about, permits and starts have had a huge divergence, and it's really trying to manage kind of what this looks like going forward as they try to close the labor gap and the raw material gap. So that's the rest of it for the U.S. And now in the next segment, we're going to pivot to Europe and look at Europe as a whole and how prices continue to explode higher, and how that's going to really a strong leading indicator for where inflation is going to go over the next several months.